Gold and silver are setting record after record, and for once it is not just the contrarians or the Austrian economists or the doomsday preppers taking notice. The mainstream is also bullish. Banks that once dismissed gold as just a pet rock are publishing increasingly larger four-figure forecasts. Market strategists who swore by the cult of equities are now talking about portfolio allocations to metals. And even the financial press, usually allergic to the word gold, is covering the rally with something close to enthusiasm. And that is where the anxiety creeps in. If the mainstream is bullish, then surely this must be the peak. When the consensus finally discovers gold, is the party already over? Gold is smashing records. Silver is tearing through levels that it has not touched in decades. And the strangest part is not the rally itself, but the chorus of questions that always follows it. Why is this happening? When will they come down? The tone is never one of curiosity, but one of disbelief, as though gold and silver were not supposed to rise. The polite expectation is that precious metals should only move quietly in the background, while stocks and bonds provide the real entertainment. Yet here we are, with both metals refusing to sit quietly, and the world is struggling to believe that this is the new normal. The headlines last week pointed to the Federal Reserve as the culprit. Jerome Powell's Fed cut rates by 0.25%, the first cut in 9 months. The official story is that the economy needs support, but the real story is that the Fed is responding to political pressure and a debt machine that has become unmanageable. Now, Harvard's Kenneth Rogoff put it plainly. The United States is adding $1 trillion of debt every 100 days. For those of you at the back, I'll say it a little louder. $1 trillion of debt every 100 days. At that pace, the central bank does not have independence. Instead, it's got marching orders. And the marching orders are very simple. Make the cost of servicing debt bearable, even if that means sacrificing credibility and sparking inflation. Now, Rogoff also warned that this dynamic will mean more inflation over the next 10 or 20 years than we would otherwise have had. But this is not a shocking revelation. Inflation is not an accident of policy. It is the policy. Now would be a good time for a quick economics lesson. In reality, central banks exist not to preserve the value of currency, but to ensure that prices rise steadily, to dilute savings slowly, and to transfer purchasing power towards those closest to the spigot of new money. The tragedy is that the public debates the morality of higher grocery bills without recognizing that this slow theft is designed into the system. So yes, perhaps the Fed cut rates last week and gold jumped perhaps a bit on the news. But the more important point is that gold was already very much in a long-term uptrend before the cut. The cut was not the reason, but just the excuse for last week. The real reasons are structural and have been in place for years. Relentless debt, political capture of central banks, and a global move away from the dollar's monopoly. Rogoff's warning is that the dollar is destined to shrink in importance. At present, the dollar accounts for just under 60% of global reserves, and he predicts that it will fall to 35 or 40%. This is not because China or Russia are more trustworthy, but because the United States has made a series of unforced errors. Weaponizing the dollar through sanctions has convinced other nations that they cannot remain exposed. If you trade in dollars, Washington can see your transactions and cut you off when it wants to. So that is not a neutral reserve currency, it is a surveillance tool, which is why central banks have been buying record amounts of gold. Over 2,000 tons in the last 2 years, not ETFs, not futures contracts, but physical gold that they can hold in their own vaults. And meanwhile, the rival to the dollar is not in much better shape. Rogoff points out that China is already in a crisis. Growth has slowed, debt is suffocating, and the path ahead looks like Japan's lost decades. If the two largest economies in the world are both compromised, then the system itself is compromised. And in that system, gold is not an outsider. It is the asset that states themselves are hoarding because they no longer trust each other's paper promises. And this brings us to the present rally. Gold is above $3,700 an ounce. Silver is above 43. And while the mainstream is asking when it will stop, the more interesting question is why anyone assumes it should stop at all. Deutsche Bank thought that gold would just reach 3,700 by 2026 and is there already. They have upgraded their forecast to 4,000 for next year. And Jefferies, using an income-based model, says that the peak this cycle could be $6,600. But if you use money supply as your anchor, the implied price is closer to 12,000. Now, are these precise predictions? No, of course they're not. They are just guesses dressed up amongst spreadsheets. But they do highlight something important. By every serious measure of value, gold is still underowned and underpriced compared to the ocean of paper assets that are just sloshing around the system. We are in the largest wealth transfer experiment in modern history. Just look at the crazy valuations in tech stocks and government bonds. Now, Microsoft and Nvidia each valued over $4 trillion, bigger than entire national stock markets. It is a bubble that looks eerily like the dot-com years. And when those bubbles burst, capital does not vanish, it moves. And the only real destination left is tangible wealth outside the banking system. Gold for stability, and silver for that explosive upside. And of course, the silver story is becoming harder to ignore. Many analysts have noted this last week that LBMA's silver inventories could be depleted within 7 months if current ETF inflows continue. There are already reports of 0 SLV shares available to borrow. And this is not simply speculation, it is a combination of years of structural deficits in the silver market. Industrial demand, particularly from solar and electronics, is colliding with investor demand. Silver is like gold's younger sibling, quieter most of the time and then suddenly making a scene. And when it does move, it tends to overshoot violently. The geographic demand picture, of course, adds another layer. Historically, Indian buyers waited for dips and Chinese buyers chased rallies, but that pattern has now reversed. Chinese demand is weak, even at record highs, while Indian demand is surging despite higher prices. Imports have doubled and doubled again in recent months. With the Indian wedding season and major festivals approaching, demand is only set to rise further. And the important point here is not whether it is India or China driving the price today. The important point is that this rally is not speculative froth. It is being supported by official purchases, structural deficits, and high conviction buyers who are not looking to sell at the first sign of profit. And yet, the common refrain remains. Surely it must come down. Surely there must be a correction. Perhaps there will be. Markets breathe in and out. But the obsession with corrections reveals the deeper bias. No one asks if tech stocks should collapse because they are valued at absurd multiples of reality. No one asks if government bonds should collapse, even though they represent loans to the most indebted nations and governments in history. The suspicion is reserved only for the assets that cannot be printed. The truth is simple. Gold is the new gold. Silver is still silver. Fiat currencies are still broken. The system is still flooded with claims that far exceed the base money underneath. And the largest players in that system, central banks themselves, are quietly hoarding the one asset that they cannot create. For investors, the lesson is clear. Stop waiting for the permission slip from Wall Street. Stop asking when the rally will end. The real question is whether your wealth is tied up in assets that will evaporate when the next bubble bursts. Owning physical gold and silver is not about calling the top or bottom. It is about stepping outside the game altogether. In 1980, gold reached 9.9% of US disposable income per capita. Today, it is around 5.5%. If it merely returns to its previous weight, well, that would imply $6,600 an ounce. If the money supply argument holds, the number is closer to 12,000. And if the everything bubble truly bursts, the figures will look quaint in hindsight. So as you hear the noise about rate cuts, political interference, and central bank credibility, remember the bigger picture. Inflation is not going away. Debt is not going away. Political dysfunction is definitely not going away. The system is designed to dilute and to deceive. And gold and silver are not rising because of one news headline. They are rising because more people, including governments, are recognizing that truth. So yes, this rally may pause, may even pull back, but the trajectory is set. And the tragedy is that while the mainstream waits for a correction, the transfer of wealth is already happening. Those who hold claims will be left holding the bag, and those who will hold assets will hold their wealth. Gold is not the trade of the year. It is the safeguard of a generation, and silver, for all its volatility, is its equally vital companion. Do not ask when the rally ends. Ask why you are still standing on the sidelines. And if you want to jump off the sidelines and instead just dive right in, why not download one of our guides in the link below?